If you wait until you're earning more to start investing, you are effectively paying a procrastination tax of nearly 26 lakh rupees. That is the exact difference between starting today with 5,000 rupees and waiting just 5 years to start with 10,000 rupees. You lose more by waiting than you can ever save by earning more later. We've all been there. It's the 5th of the month, the salary hits, and for 10 seconds, you feel rich. By the 15th, you're checking your balance just to see if you can afford that blanket order. Most people think the problem is their salary. It's not. It's the leftover trap. Today I'm using 2026 math and 30 years of Nifty data to show you how a completely normal Indian salary builds a 50 lakh rupees corpus without skipping your daily tea. This is the step-up strategy nobody else is showing you. Okay, real talk. It's the 5th of the month, your salary just hit, you open your bank app, feel that brief rush of, oh, I'm rich, and then boom, rent, EMI, Swiggy, Amazon impulse buy you forgot about, petrol, blink it at 11 p.m. Somehow by the 15th, you're back to 12,000 rupees in your account doing absolutely nothing. And you tell yourself the same thing you told yourself last month. I'll start investing when I have more money. Sound familiar? Yeah, that's exactly the trap. And what kills me, what genuinely frustrates me, is that the fix isn't complicated. You don't need a massive salary. You don't need to time the market. You need 5,000 rupees a month and a decision. That's what this video is about. I'm Rohan and I spend way too much time thinking about why ordinary people in India never build wealth even when they earn decent money. If you're someone who saves in principle but struggles to actually grow anything meaningful, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today I want to show you with actual math, actual data from 2026, how a completely normal person earning a completely normal salary can build a 50 lakh rupees corpus through small, consistent monthly wins. And no, I'm not going to tell you to skip your tea. Let's get into it. Here's the thing most people don't know. As of January 2026, there are nearly 9.92 crore active SIP accounts in India. That sounds like a lot, right? Nearly 10 crore people investing systematically every month. But India has over 100 crore adults. So we are talking about less than 10% of the adult population actually building wealth through systematic investing. The rest, still parking money in fixed deposits, gold, or just spending it. And look, I'm not saying FDs are the devil, but here's what nobody tells you at your bank branch. The average FD rate in India right now is around 6.5 to 7% per annum for major banks. Sounds fine, right? Now subtract your tax slab. Say you're in the 20% bracket. You're left with roughly 5 to 5.6% real returns. Then knock off inflation. CPI is projected at around 3.2% in fiscal year 2026, according to CRISIL. Your actual real inflation-adjusted return from an FD? Barely above zero. You're not building wealth, you're just not losing it, slowly. Meanwhile, equity mutual funds through SIPs have historically delivered 12 to 15% CAGR over long periods. That's not me making up numbers, that's decades of Indian market data. The difference between those two numbers, say 6% versus 12% on 5,000 rupees a month over 20 years, that's the difference between 23 lakh rupees and 49 lakh rupees. Literally double. Same money, same discipline, just a different instrument. Now you might be thinking, Rohan, 5,000 rupees a month, that's easy to say. I have EMIs, parents to support, rent to pay. And I hear you, I genuinely do. But let me challenge the assumption underneath that thought. Most people believe wealth building is a big dramatic event, a big bonus, a lucky stock pick. That brother-in-law who bought Infosys in 2002 story you've heard 47 times at family dinners. Here's what most people don't realize. The entire science of compounding doesn't care about big events. It rewards frequency and patience. Think of it like this. You know how a WhatsApp forward gets shared? One person sends it to 5, those 5 send it to 25, those 25 send it to 125. Nobody made a big move. The magic was repetition. Compounding works exactly the same way. Your 5,000 rupees goes in, it earns returns. Those returns earn returns. Those returns earn returns. It sounds boring. It looks boring, and then one day you open your portfolio and genuinely do not understand where that number came from. That's the magic. And most of us are sleeping on it because we are waiting for the perfect moment to really start. Okay, let's get specific because this is where I want your jaw to drop a little. A study done using 30 years of Nifty data from 1995 to 2025 showed that a simple monthly SIP of just 10,000 rupees grew to approximately 3.38 crore rupees at an IRR of about 12.48%. Total money invested? Exactly 36 lakh rupees. That's 360 months of 10,000 rupees. Total returns? Nearly 3.4 crore rupees. That's nearly 9 times your money from doing nothing heroic, just showing up every month. Now, let's talk about our actual target today, 50 lakh rupees. Here's how you get there. Scenario 1. The patient 15-year plan. You invest 8,000 rupees per month for 15 years at a 12% CAGR. Total invested 14 lakh 40,000 rupees. Corpus at the end, approximately 40 to 42 lakh rupees. Almost there with just 8,000 rupees a month. Scenario 2. The 12-year sprint. You invest 15,500 rupees per month for 12 years at 12% CAGR. Total invested 22 lakh 30,000 rupees. Corpus approximately 50 lakh rupees. That's the 50 lakh rupee target crossed. Scenario 3. The SIP step-up strategy. This is the cheat code. You start at 6,000 rupees per month but increase your SIP by just 10% every year, which is roughly in line with average salary increments in India. By year 15, your monthly contribution is around 23,000 rupees, but your corpus, it's compounding on a growing base the whole time. Outcome at 15 years, roughly 50 lakh rupees. Starting smaller, growing steadily, ending at exactly the same 50 lakh rupee destination, with a lower monthly burden in the early years when your salary is smaller. This is the strategy most financial influencers won't show you because it doesn't sound dramatic enough, but it's the one that works for real Indian salaries that get real annual increments. And I want to pause on something here because the math is actually the easy part. Here's what I've noticed talking to hundreds of people about money. The reason people don't invest isn't lack of information. In 2026, you can literally download a mutual fund app in 3 minutes, complete your KYC with Aadhaar in 5 more minutes, and start a SIP with 100 rupees. The information is everywhere. The access is there. The real problem is psychological. There are 3 mindset traps that kill wealth building before it even starts. Trap 1. I'll invest the leftover. If you save what's left after spending, you will never save. Full stop. Your spending expands to meet your income. That's called Parkinson's law applied to money. The fix? Automate your SIP on the day your salary hits. Not after groceries, not after rent. Day 1. Treat it like an EMI you owe your future self. Banks in India have been moving toward UPI-based SIP mandates. Set it up once and forget it. The money moves before your brain even knows it's gone. Trap 2. The market is too high or too low right now. This one drives me absolutely crazy. Look at the data I just showed you. Over 30 years of Nifty, bull markets, bear markets, demonetization, COVID crash, everything. The simple monthly SIP still delivered 12.48% XIRR. Know why? Because SIPs use volatility. When the market falls, your 8,000 rupees buys more units. When the market rises, your existing units are worth more. You win on the way down and on the way up. This is called rupee cost averaging, and it is genuinely one of the most powerful free tools available to retail investors. Trap 3. Something better will come along. The cousin who made money in crypto, the uncle who doubled money in a real estate deal, the colleague who knows a guy with a hot stock tip. Here's what most people don't realize. You never hear about all the cousins, uncles, and colleagues who lost money chasing those stories. Survivorship bias is the most expensive psychological trap in investing. You hear the wins, the losses are quiet. Meanwhile, the boring SIP investor, she's on a cruise in 2040, portfolio intact. This is where it gets really interesting and why I think 2026 is actually a pivotal year for retail investors in India. Look at what's happening in the market right now. The mutual fund industry's total AUM has crossed 55 lakh 86,000 crore rupees as of January 2026. Total SIP contributions in 2025 alone were 3 lakh 3,000 crore rupees. That's a record. Monthly SIP inflows have been holding steady above 30,000 crore rupees even during periods of market volatility. Think about that for a second. 30,000 crore rupees every single month from regular Indian investors showing up with discipline regardless of market noise. And here's the fascinating part. The domestic retail investor is no longer the nervous panic selling type of 2008 era. The behavioral shift is real. During the volatility of late 2024 and 2025, SIP inflows held steady. People didn't stop, they kept going. At the same time, the ratio of mutual fund AUM to bank deposits, which was just 12.6% in 2015, has now crossed 33% in 2025. The country is slowly, steadily waking up to the idea that your savings deserve better than a 6.5% FD. But here's the thing, and I want you to sit with this. Even with all this growth, only 10% of Indian adults are participating, which means 90% of people are still missing out. The seat is still warm, you can still get in without having missed it. The compounding clock starts the day you start, not next month, not when the market corrects. Today.
Now you might be thinking, okay, Rohan, but what if the market crashes just before I need the money? Fair, genuinely fair question. And this is exactly where goal-based investing comes in. This isn't just a buzzword, it's the framework that stops you from making panic decisions. Here's how it works. If your 50 lakh rupees goal is more than 7 years away, equity mutual funds, specifically diversified flexi cap or large cap funds, are your weapon of choice. Time absorbs volatility. Every market correction in Indian history has eventually been followed by new highs, every single one. If your goal is 3 to 7 years out, a hybrid fund or balanced advantage fund gives you some equity upside with reduced volatility. You're not all in on equity, not hiding in an FD, a sensible middle ground. If the goal is under 3 years, FD, liquid fund, short duration debt fund, no equity, capital protection over growth. The math doesn't work for equity at short time frames. This simple framework alone, matching your investment type to your time horizon, would save most Indian investors from 80% of bad decisions. Alright, let me make this practical, because a 14-minute video with no action plan is just entertainment. Step 1. Calculate your SIP number. Open any SIP calculator, Grow, Zerodha, ET Money, doesn't matter. Plug in 50 lakh rupees as target, 12% assumed returns, and your time frame. What SIP amount does it give you? That's your number. Don't negotiate with yourself. That's the number. Step 2. Automate it immediately. Pick your fund. I'm not here to tell you which fund. That's a separate video and depends on your risk profile and goals. But choose a SEBI-regulated mutual fund from a reputable AMC. SBI, HDFC, Mire, Parag Parekh, Axis. They're all regulated, audited, transparent. Set up an auto-debit mandate through your bank or UPI. Done. SIP is running. Step 3. Set up the step up. Most fund platforms now let you set an automatic annual step up, say 10% every year. Enable this. This one checkbox will add lakhs to your final corpus compared to a flat SIP. It's the single highest leverage setting most people ignore. Step 4. Build your 3-month emergency fund first. This is non-negotiable. Before you go all in on SIPs, park 3 months of expenses in a liquid fund or a high-yield savings account. Why? Because if a medical emergency hits and you have no buffer, you'll stop or redeem your SIP. And stopping an SIP early is like pulling a plant before the fruit appears. Emergency fund equals SIP protection. Step 5. Ignore the noise. WhatsApp groups with multi-bagger stocks. YouTube videos with thumbnails like, "This stock will 10 times in 6 months." You know the ones. Budget announcements, US Fed decisions, FII outflow headlines, none of it matters for a 10 to 15-year SIP. Literally, none of it. The biggest risk to your wealth isn't market volatility. It's you reacting to news that doesn't affect your 12-year SIP goal. Let me tell you about someone. I'll call her Priya because that's actually just a very common name. Priya is 28. She's a mid-level professional in Bangalore earning 75,000 rupees a month. Her rent is 18,000 rupees. She has a two-wheeler loan EMI of 6,000 rupees. She spends around 15,000 rupees on food, going out, subscriptions, the usual. She saves roughly 12,000 to 15,000 rupees when things are normal. For 2 years, she kept that 12,000 rupees in her savings account. Safe, she thought. Available. One day she does the math. At 3.5% interest, which is what most savings accounts pay, her 12,000 rupees a month over 2 years grew to barely 3 lakh rupees. Net of inflation, she actually lost purchasing power. She starts an SIP of 10,000 rupees a month, sets up a 10% annual step up, picks a flexi cap fund, automates it. She doesn't patch it. Market goes up, she doesn't touch it. Market goes sideways in late 2025, she doesn't touch it. Her friends panic, she goes for a run. By year 12, she's 40. Her portfolio is sitting at approximately 48 lakh rupees. She invested about 25 lakh 60,000 rupees in total, factoring in the annual step-ups. Her return? Over 22 lakh rupees in pure compound gains. That's not a rounding error in her favor. That's not a lucky stock. That's just time doing its job. She didn't pick stocks. She didn't time the market. She just didn't quit. That's it. That's the whole story. Here's the part of this equation almost nobody talks about. The real magic of the 50 lakh rupees SIP isn't the 50 lakh rupees, it's what happens after. Because here's the thing, a 50 lakh rupees corpus earning a conservative 8% per year generates 4 lakh rupees annually in returns. That's 33,000 rupees per month in passive income from money you don't touch. At 12%, it's generating 6 lakh rupees a year, 50,000 rupees a month. At that point, your portfolio is earning more per month than most Indians earn from their jobs. The money is making money and you are free. This is what financial independence actually looks like. Not some dramatic event, not a startup exit or a lottery win, just an SIP running quietly in the background for long enough. And it started with 5,000 rupees a month and a decision you make today. Look, I know personal finance can feel overwhelming. I know there are 50 YouTube channels, 200 WhatsApp tips, and a new best investment of 2026 headline every week. It's noise. Most of it is noise. Here's what I want you to walk away with from this video. 1. Small amounts matter enormously over time. Don't wait for the right amount. 2. Automation is your best friend. Take emotion out of it. 3. Time in the market beats timing the market every single time. The 30-year data said so. I'm not making this up. And 4. The best time to start was yesterday. The second best time is right now. Open that app. Start a 500 rupees SIP if that's what you can do today. Then make it 5,000 rupees next month. Then step it up. The 9.92 crore people with active SIP accounts in India, they're not all finance experts. They're not all high earners. They just started. If this video helped you see something differently about your money, please hit the like button. It genuinely helps this channel reach more people who need to hear this. Subscribe if you want more videos like this and drop a comment below. Tell me, what's your SIP goal? 50 lakh rupees? 1 crore rupees? Let me know. I read every comment. See you in the next one.